Please welcome to the stage Federal Reserve Bank of New York President and CEO John Williams in conversation with U.S. financial editor of the Financial Times, Brooke Masters.
Good morning, everybody. I hope everyone's had their coffee. So John, when we were talking in the back, I said, obviously, we have to start with Friday's jobs report and what that does to your and the broader FOMC's view of interest rates and inflation.
Yeah, so I'll take a step back on that. I think what we're seeing is a gradual kind of bringing supply and demand together, or bringing balance back to the economy. The jobs report, I think, was consistent with that. We saw continued slowing in wage growth. We're seeing job growth slow a bit, and other indicators say we still have a strong labor market. Unemployment's been below 4% for over 2 years now. We saw a strong economy, but we are seeing a continuation of the process of supply and demand getting back into better balance, which I think of as a critical component of really getting inflation back to 2% on a sustained basis. So I see this as a part of a continual process. I will say every month's data can move up and down in unpredictable ways, and so I don't want to get too caught up in each data release, but look at what's happening, say, over the last year and a half, and I think this is consistent with what we've been seeing and what we need to see.
How many more months do you think we need like this kind of data before the Fed gets comfortable with, doing that first rate cut that everyone's so waiting for?
Well, for me, it's really looking at the totality of the data, not just looking at an employment report or a CPI or other piece of information. You really want to make sure we're looking at the broad picture. We have the maximum employment and price stability goals. So we want to, from my perspective, see all the data and information that speaks to all of that, and really, as the data, come in, hopefully, we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy, and then we'll make our decisions based on that. When I wake up in the morning, I think about data. I'm not sitting there immediately asking myself, well, what's it mean for the Fed funds rate or the path of the Fed funds rate? I really start with what are our objectives? How are we moving towards our objectives, and is it slowing down or speeding up? And then thinking about, okay, is the stance of monetary policy appropriate for where we are? And I think right now it's very much so. We have a restrictive stance of policy that's helping us achieve our goals. And then you think, well, down the road, do we need to keep that stance in place, or eventually, I think, we'll have rate cuts. But right now, I think policy's in a very good place, and we have the time to collect more information and hopefully continue to see progress.
So steady as she goes?
That's the way I see it. But it's really looking at all the data. And one thing I think you have to understand, we're not just looking at the CPI or the employment report or GDP. It's amazing how much data we have now from the various providers on the labor market, on the housing market, across the country in different surveys. And it's really looking at all of that data, some of it more forward-looking, some more backward-looking. And trying to, if you will, tease out what is this telling us about where we are and where the economy is likely going.
I'm interested, you mentioned getting supply and demand back in balance. We obviously had this massive supply shock. Do you feel that is continuing? Do you think it's easing off?
Well, I think the story of 2023 for understanding how did the economy grow at 3%, how did inflation come down as quickly as it did last year, I think you have to understand this in the context of a big positive supply shock. There's basically three components of that. First, labor force participation. The people being in the labor market, either having jobs or looking for jobs, fell pretty significantly during the pandemic, and it's been coming back, and it continued to come back last year. So that's a really positive sign. We're seeing the labor market come back to the way it was before the pandemic. We've also seen pretty strong increases in the labor force through immigration, and that seems to be continuing. And then we've seen pretty strong productivity growth as well. Now, I'm not jumping into thinking we're in a new rapid productivity regime, but that's definitely a positive sign that as the economy continues to grow, we're seeing strong supply side in all these components. Thinking about this year, I think the increase in labor supply from immigration is continuing. Labor force participation is probably getting close to its kind of peak level. That's really a good thing, but I don't expect continued significant improvements there. And productivity is a bit of the wild card. Are we going to continue to see that strong growth, or is it really just a reflection of the extraordinary kind of experience that the economy's been going through the last few years, through the pandemic, Russia's war in Ukraine, and the rebound of the global economy, and we've seen the diminishment of supply chain issues. So it's hard to read the tea leaves on productivity. Right now, I feel like we've seen a good rebound in productivity growth. We'll see how far that continues.
These days, you can't talk about productivity without mentioning those wonderful letters, AI. Do you think the current enthusiasm for artificial intelligence is going to have a meaningful impact on productivity?
Well, it's clearly having a meaningful impact on investment. I mean, you talk to business leaders in technology or in any area, financial services, AI is always at the top of the list and where people are investing and thinking. I don't think it's the story yet about productivity because it's just starting, and we know from history that it usually takes years before investments in new technology really show up in terms of productivity. I do think it's one of the drivers of very strong investment today. I think the big question that's out there is, how is AI going to be used? Is it going to be used to increase productivity and new products and new things that we can do better than before, or is it really seen as a way to just cut costs? I think the former one is the more transformative one. That's the one that says we have the ability to do things we weren't able to do before or do things better. And I think that's if that's what happens, we could see a period of very strong productivity growth and strong growth like over the next decade, like we saw in the late 90s and early 2000s. But we still don't know because it is early days, but there is a lot of excitement out there.
The other side, of course, would be if it's just used for cutting costs, what does that do to labor force participation and other things?
Well, I think that that is one of the big questions because we know that with technology and computers and automation and things, we did see elimination of a lot of types of work replaced with automation or with the examples typically are that if a bookkeeper role has now been replaced by spreadsheets and other things. So that kind of thing can happen, and I think that a lot of people are thinking about what jobs may be replaced by automation. Again, I think if we think as business leaders and we think as like this is an opportunity not just to say, well, we don't need someone doing that anymore, and you can think about writing emails or all the things that AI can do for you, but then take that question and say, well, we've got these really talented people, like we do at the New York Fed, and how can we get them using this technology to be even better at understanding what's going on in the markets, better at understanding what's going on in the economy and in the banking system. So I think that's the thing that we're going to, as leaders, really need to be thinking in a new way about, not just using AI, but how do we really kind of leverage AI to do what we do better and boost productivity.
I think people want to know, are you at the New York Fed using AI for something specific yet, or are you still just thinking?
We're much more in the analyzing it, trying to understand it. When you're in the Federal Reserve, there's two things you try to do well. One is understand what's going on in the world around us. So we have to be experts at AI because all the banks and financial institutions and the economy's using it. So there's that part of it, which is more of the understanding it. And then the second, which we're in early days on, is really thinking about how we can do the work that we do now better using this. And one of the issues we run into, like many of you do, is that we want to make sure that our use of AI doesn't, kind of leak out into the world, so that people will be saying, well, what's the Fed searching for? And
ooh, that would be bad.
And so, there's those kind of issues about, we take data security and things like that very, very seriously. So we're working through this, but I think we're working through it in much the same way that a lot of, businesses, industries are doing today.
Another thing on the Fed's agenda, of course, is quantitative tightening, and interested in and how that fits in with all the discussions about rates and trying to everybody. It seems like we're having that soft landing everyone wants, or maybe we're even having Goldilocks. So how does quantitative tightening fit into all this?
In my career, because I've been on the FOMC now, I guess 13 years, we come up with these very nerdy names for the things we do, balance sheet, shrinking the balance sheet and things, and immediately people in the media and the markets come up with clever, interesting names, and those stick. So quantitative tightening, QT, is the term of art. So after, just to put some context for everybody, in 2020, the Treasury market, the kind of fundamental core financial market for the entire global economy was under a lot of stress because of the effects of the pandemic and concerns in markets about what that would mean. And from that kind of basically day, we started buying a lot of Treasury and mortgage-backed securities to support the functioning of those markets, which was completely successful. We were able to restore a good functioning of those very quickly. But at the same time, buying longer-term assets to push interest rates down to give the economy an extra boost to make sure that the pandemic didn't lead to worse economic outcomes. Well, now that that's all behind us, what we're doing is letting our balance sheet shrink over time, the QT process. I think the lessons we've learned from the past is, one is communicate this as clearly and early as possible. We laid out the principles of our approach back in 2022, and we've talked about that, I think, very clearly. The process has gone very smoothly, and we've just made an adjustment to that process. But again, everything is moving exactly as expected. We've seen the balance sheet and our securities holdings come down by now over $1.5 trillion without really much of a ripple or in the marketplace. Yeah. And so we're just hoping to make sure that continues and watching that carefully.
Should we talk about retail and business spending? We've obviously had a jobs report that was somewhat different we had a little bit of a turn there. Do you think spending is going to change as well?
Yeah, my view is, we had 3.1% GDP growth last year, which was a huge surprise to everybody. I think the big driver was the supply side factors we talked about, labor force and productivity. Right now, we're seeing consumers continue to spend. Businesses are investing quite a bit right now. But I think you have to understand it in the context of the supply side, boost that we're getting. So my forecast for growth this year is somewhat slower than we saw the 3% we saw last year, probably something in the 2 to 2.5% GDP growth for this year, but still pretty strong and consistent with an economy that's getting into better balance. And so a lot of economists would say that the trend growth rate for the US economy is around 2%. So how do I say that, well, 2.25, 2.5 is consistent with that? It's because we're getting this boost from the supply side that allows us to get both the good growth, good consumer spending, good business investment, and at the same time the economy getting back into balance. So my expectation is that we're going to have good growth, somewhat slower than last year. And in consumers, unemployment's low, job growth is strong, real wages are improving. It's not that surprising that they're willing to spend.
There was some interesting commentary from some of the big retail-facing companies in their results in the last couple of weeks. Specifically, I'm thinking of McDonald's and some of the companies that deal with the lower part of the economy. They're cheaper, and they feel that their customers are stretched. And some of the luxury companies' life is just peachy. Do you buy this whole idea that we're getting to be more and more of a K-shaped economy?
Well, I would say that some of this is a bit of a reversal of what we were seeing in previous years. During, there was a lot of fiscal support for households and for, additional unemployment insurance benefits during the pandemic and after that. And so we did see consumer spending by lower and moderate income households much higher than you normally would have seen. And we had this, excess savings, we called it, kind of an economist way of talking about the fact that a lot of people put money in their bank accounts and we're spending that over time. We do think that that's mostly, or for lower and moderate income households, has been spent down quite a bit. And we are seeing some delinquency rates on credit cards and auto loans pick up. New York Fed has data we publish on that regularly. So we are seeing signs, I think, consistent with what we're hearing from the retailers, that many households are kind of, being much more careful about their spending, and we're seeing some slowing there. On the upper end, I think that's described, well understood through the, very strong stock market, equity values, and household wealth probably explains part of that. But again, I think in the big picture, it's an economy that's still healthy, but growing somewhat slower.
Now this was asking you to venture into territory that's not necessarily yours, which is the IMF has been warning about the amount of spending that the US has been doing in deficit spending. And you also hear from folks in the markets who are investors that they are concerned about this. What do you think of the deficit, and how does that influence the way you look at where the economy is going?
Well, as you were predicting, I'm not going to speak about what Congress or administrations are doing. Fiscal policy, that's their responsibility. Our responsibility is really in monetary policy. Clearly, not just in the United States, but around the world, we saw significant increases in spending through the pandemic. Now we're seeing increases in plans for defense spending, given the geopolitical tensions around the world, and starting with Russia's invasion of Ukraine. So it's definitely something that we look at. We watch how the markets are functioning. It was a big concern that, as we step back from our QE to QT and reducing our holdings of Treasury securities, and at the same time the U.S. government was issuing more debt, that we might see disruption there, and we have not seen that. Markets have handled that. Looking globally, given how much debt, government debt is out there now, I mean, clearly this is an issue that people are watching carefully. I think the main, from my perspective, I mean, the main thing is it means all else equal, somewhat higher interest rates around the globe. But again, I would not focus just on the United States. This has been more of a global development.
Another global development that is of particular interest in the U.S. is the question of the final BoS End Game, they like to call it, which is the end of the implementation of tighter rules for banks. We're hearing a lot of warning from the financial services sector that it will affect their ability to lend to the economy, and that will ruin this wonderful Goldilocks moment we're in. Do you have a sense whether that can be implemented in a way, or will it be implemented, first of all, and can it be implemented in a way that doesn't upset the markets?
Well, as you know, the Board of Governors has put out proposals. It's not something that I'm directly involved with, and it's a responsibility of my colleagues in Washington. They put out proposals on this. They've gotten, I think, an extraordinary amount of feedback from the
advertisements. If you walk through Washington National Airport, there are advertisements.
As Chair Powell has said publicly, clearly they are examining and thinking about all of that, and I'll leave it for them to make it, have any comments about that. But clearly, there's I think a very strong understanding of all these issues, and they'll be working on how to come up with an appropriate proposal on when they do.
Looking longer term, we've been talking mostly about sort of the economy in the next couple of years. There is, people talk, there's a looming demographic problem, which is that, the labor force in many countries, including the US, is aging, and immigration helps but doesn't solve it. And there are we're coming into the age where people are retiring without adequate pension. How does that play into where you think the economy is going and what needs to be done?
Yeah. So again, I think this is a global issue. For the U.S., we had the baby boom generation, which I'm at the very tail end of, so we tend to focus a lot of our discussion in the U.S. But if you talk to people around the world, look at the data around the world, starting with Japan, and then South Korea, I would say, and then in Europe, and then around the world, and obviously China, we're seeing two really important demographic developments broadly. One is much lower birth rates almost everywhere in the world, dramatically lower, and that's been happening over decades. And the second is, in most countries, people living longer and therefore having to save more during their working life for their longer retirement. We are not seeing people on average working longer, later and later that much. It's more about needing to save up for the future. So this is something that's been going on now for decades. We are now kind of seeing it, so dramatically, even in the U.S. and in other countries. So I think the biggest, kind of most important thing is you think about how do you fund, government when you have fewer people working relative to the population, something that Japan has been dealing with for a long time. You also think about what does it mean for your country. If your population and workforce are actually shrinking, you need less investment, and not even if even if it's just not growing very much, you need far less investment. You need to build fewer new roads or schools or factories or whatever. So it really does shift kind of where the economy's investment and spending mix is. And I know we're going to get to this question, but it really is one of the big factors that's driven down investment demand for now 25 years around the globe, starting again, I would say, with Japan and Korea and other countries, and then spreading further. We don't, because our populations are growing less, because people are saving potentially more for retirement, the supply of savings, demand for investment have gotten moved in kind of the opposite directions, leading to lower lower interest rates around the globe. And so that's a development that really continued all the way up till the pandemic. There's a lot of discussion today has that changed? Now are we expecting to see higher interest rates in the future than we saw the last decade? But I think whenever you talk about that question, you have to start with the demographics. If we're in a world that has lower demand for investment because we have less population growth or even negative population growth, and if we have this extra supply of savings, it's going to be pushing, in terms of a trend, not in the short term, but the long term, interest rates lower, not higher.
Well, let's tease that one out. Like, we've been told it feels like for decades, the 2% is the appropriate rate of growth and the right rate of inflation. Long term, what is the natural rate of inflation? This is your academic.
Inflation or interest rates?
Of interest rates.
Right. Yeah, so I think that, again, if you think about this globally, not just in the US, it sounds like I'm just saying the same thing over and over again, but I think that's lost because all of us get very caught up what's happening in our country. Then you talk to people in Asia, you talk to people in Europe or South America, you realize we're all kind of facing the same set of issues. So I think the demographics have been pushing longer term interest rates lower. Now the big question for us is today, is this different?
Yeah.
What has changed? So the story I hear is the investment in AI, the investment in the green economy, especially around green energy and transmission and all of that. That these will be big drivers of higher investment. Extra additional defense spending, probably in the world, will be drivers of extra spending. At the same time, there is concerns that maybe some of these extra savings we were seeing won't continue. I guess my answer to that is we're going to have to wait and see. Right now, the demographics are clearly continuing in one direction, and as we watch how the economy evolves in future years, if we got a sustained productivity boom out of AI, if we did see, a significant increase in investment on energy, production and green energy and all that, then that would probably be something that would offset the very low global interest rates. I definitely see a lot of people jumping to conclusions on that, and my answer is we don't know. We'll have to just see how that evolves, but some of the fundamental things haven't changed, at least yet.
Trade barriers are something you didn't mention, because that's also something that might affect interest rates. Do you have, it's pretty clear there are more trade barriers, and there's also this whole new emphasis on resiliency means that some of the supply chains are less efficient, although they're more resilient, and that's a trade-off. That also might contribute. What do you see? How much of an impact does that have in your vision?
We clearly got a big boost to efficiency and kind of lower cost import goods through globalization. For decades, we saw opening of markets, especially China, and quite honestly, the whole world had a lot of positive effects in keeping costs down and increasing kind of global markets, and those were, we saw those effects. If we have deglobalization, or what many call fragmentation, I think some of those effects could reverse. It's not clear that we're seeing huge effects yet. We're seeing a lot of supply chains move closer to us, some of it right into the US, but into Mexico, into other countries, or Southeast Asia. So I think the big question to me is this a relocation kind of between different countries? And we always hear about is maybe more supply chains coming from Vietnam or countries like that, or is it a fundamentally less trade? Right now, I think we've seen kind of trade volumes kind of plateau, but not seen any yet signs that we're moving away from kind of an open economy and a global kind of approach. So again, I would say right now it's wait and see. We definitely are seeing some of the impact of that. A lot of investment in Mexico, for example, to be closer. And as you pointed out, some of this is a trade-off between either national security or resiliency concerns versus what's the cheapest way you could do that. And those are reasonable things. But I guess I right now feel like this idea that we're completely fragmenting the global economy, it seems premature. to say that.
Interesting. We also, obviously, we've had a couple of very large geopolitical shocks. Do you think, and the one that seems to have the continuing impact is the war in Ukraine and possibly unrest in the Middle East affecting energy. At the same time, we're also trying to go green. How do you see both higher oil prices, which stimulates presumably oil production, given if the world works the normal way, and this need to decarbonize, interacting in sort of affecting prices and what happens to the economy?
Well, I think that, again, Russia's invasion of Ukraine and the war that's gone there has been a huge story of what's happened in the global economy. If in terms of energy prices, food prices, the supply chain disruptions we had, if we hadn't, just speaking to the economics of this, if we hadn't had that war, I think we would have seen a more rapid kind of normalization of economies around the world. Inflation would have come down much more quickly. So again, I think it had a dramatic effect. Now we've seen some of those effects kind of diminish. We've seen Europe find ways to get the energy they need from other sources and adjust to that. And that's gone actually, I would say, smoother or better than many predicted. That said, I think it has revealed a greater fragility in our global economy to these kind of events. And you think about cutting off ability to move goods through especially energy, but also more broadly goods through different parts of the world. And then we have natural kind of constraints on that too with canals. And so I think that it's teaching us a lesson that I think that it's hard to predict the future, but it's a lesson that there's probably greater volatility in the global economy in the future than maybe we were used to in the 90s and 2000s before the pandemic. It's not a statement about the supply chains per se, but more that there's just a lot of things that can go wrong, and when those things go wrong, that can interrupt supply in economies. We have to adjust to that. So, one way to think about it is the world of very low volatility, the kind of may be behind us, and we have to be prepared for that.
And sort of trying to tie that together with the very beginning conversation, does that mean that rates stay higher for longer because there's just more stuff built in?
Well, I don't think that has an obvious prediction. I just think that we just have to be aware that if I go back to when I was young, we had the supply shocks of the 70s. We saw the productivity slowdown of the 70s. We saw the oil shocks of the 70s and things like that. We had a period where supply shocks were not the big driver of the global economy, except if they were probably more positive through opening up the global economy. That now we just, I think, maybe have to be prepared for more of a kind of a balance and uncertainty about that. But it doesn't have direct implications for policy today. And
talking to greening of the economy again, there is this sense, if we have to replace a lot of our capital stock to switch to different sources of energy and have more redundancy because the wind doesn't always blow, does that also weigh on the economy? I mean, you've said there's the two balances, the aging of the population and then this. Do they balance evenly? Do you have a sense which one is heavier?
Well, it really depends on how it's financed. So one of the things that you've seen around the world are different approaches to investments in energy and investments in kind of infrastructure around energy. And to the extent that is supported through government subsidies or other programs, that is probably going to lead to a lot more investment, faster movement on that, but that it probably is a driver of higher, stronger investment demand. To the extent that that's not happening or is paid through maybe taxes or other things, that it doesn't necessarily mean you're going to see this big boom in investment. It may be a little bit more drawn out. And the reason I mention this is that it's being approached in different ways in different parts of the world. I mean, all around the world there's a lot of investment in renewables and things, but to how it's being funded, to what extent it's replacing investment that would have happened on non-renewable sources, I think that's where it's like, is it a net positive for investment, or is it basically just a replacement of what was going on? You mentioned that with energy prices high, that creates a little bit more supply of oil, but it also really does incentivize more investment in renewables, and we've seen that too. So at the end of the day, we're going to have to figure out net, is this a big investment boom? What I always advise people to do is don't add up numbers in this. You have to think about the gross kind of investment will be you know, a lot will be big, but it will also be counterbalanced by a reduction in investment in other areas or spending in other areas. So you have to think about how the two fit together. And for us, you know, you think about monetary policy and the economy, it's really trying to assess on an ongoing basis, what are the forces affecting demand, affecting supply, what are the uncertainties around that, and try to navigate that, you know, with our focus, which is not about any of those policies, but really about just how do we keep the economy in a good place, strong labor market, and 2% inflation on a sustained basis.
Well, with that, we have hit our timing buzzer. It seems like a good place to stop. Thank you so much, John Williams.
Thank you.